Hello guys, welcome to this YouTube video.
On today's video, we're going to be explaining how we would trade a rising wedge pattern and a range.
So let's get into it.
Right guys, I'm going to run through Euro CAD, which was a trade back in July 2018. And yeah, to start off with, we can see in May 2018, we can see that price started to form a bullish market structure. And this was shown with the ascending channel, which we were in. As you see, price was making higher highs and higher lows. And we can see we're just moving in upward trend, which was shown in this ascending channel. Then when we got to the start of July 2018, we could see that price broke out of this channel, and therefore our buy switched from being bullish to bearish. And after this impulsive move from the top of the ascending channel, we normally look for impulse and then some sort of correction. In this case, it then turned into a range, which we're going to trade and look at now. So as you can see here, we had this impulsive move to the downside, and then price started to correct sideways. And this type of market structure is called a range, where price is stuck in indecision, where it's just moving side to side in the market. So as you can see here, when we broke the ascending channel, our bias switched from that bullish market structure to now this bearish market structure. So as you can see here, where we had this false breakup to the upside, lots of traders would have been trying to buy that on that bullish engulfing candle there, breaking the highs, because they would have seen that as, oh, this is a breakout, we need to get in the trade right now. But this is just trapping people, and this is a false breakout. So this is to trade a range properly. This is the key things you need to do in order to catch the best and safest trade. So while we're in this trade, we need to allow price to break out for a period of time, come back and retest, and then continue in that direction. And that's key, because then we're breaking out of the indecision in the market, coming back to retest it, and then continuing. As you can see here, this was a false breakout, trapping people in. Price made an impulsive move to the downside for a long period of time, breaking the lows. And then what did price do? Price then pulled back into our area of interest, which is the support level of the range. If I draw in my Fibonacci for swing high to swing low, we can see, so let me draw in, boom, boom, boom. We can see that price came back and retested the 50% Fibonacci level, and we also came back and retest the range, which is great. And this is where you can trade off. So as you can see here, boom, this is the 4-hour chart. We did form this 4-hour evening star. So lots of traders using higher time frame trying to catch in swings would have entered probably off that there. Stops would have been just above. You see here we had the 50 SMA coming around. Stops would be just above that, just above these highs. And obviously we've got here a target end of the major low, also the 90 ray, because we broke the ascending channel, which would give us the 90 ray here. And boom, that'll be our targets, which would be a nice 1 to 4 for this trade. And this would be a beautiful trade back in July time, 2018, which you could have caught. So yeah, this is how we would trade a range on the forex market.
Okay guys, so I'm going to be talking about the rising wedge and how you can implement it and potentially forecast a potential reversal within the market. So using this example from the past, we can see that price has been making higher highs and higher lows. So we know that we're in bullish market structure, and then you can see we had this bigger, much more impulsive bullish move to the upside. And then we had a much bigger pullback followed by another impulsive move. So we can say that now this is where we're going to start mapping out a potential rising wedge, because you can see that we are making higher lows. However, the higher highs are getting a lot smaller. And what this means is the bullish momentum that's stepping in, the buyers are unable to drive the market higher from the strength that they've been using previously. And I'll show you what I mean in a second. So this is just me mapping out the highs and the lows in the market to potentially predict a reversal. So then we'll join our highs, something like this. And we will also join our lows, something like that. Now there's a tool here called price range, where you can actually see the how many pips each impulsive move is, So if I just draw it from the swing low to the swing high here, you can see that this one is 293 pips. If I do the next one, you can see that this one is 217 pips. So this is why from here, we can already start to predict a reversal, a potential reversal, as the impulses are getting a lot smaller. So let me just keep going from swing lows to swing highs. This one is 192, so getting smaller and smaller each time. On the bottom here to there, that one's 164. So we can start to map out a potential reversal as we're getting smaller and smaller. But how do you actually take an entry from a rising wedge? And this all depends on your own individual style of trading. Some people, if I just delete some of these, some people may start to predict a double top formation here. Some people might be looking to trade potentially off this evening star formation there. Let me just draw that up. Some people may enter on that evening star, as I was saying, with their stops in a safe place above, and obviously moving to the downside. As you can see, we did have a big reversal. So this is the evidence that this was actually a reversal pattern. So some people might enter on a double top. Some people might wait a little bit for a little bit more confirmation and actually wait for the breakout. So some people may enter at a more later stage of the market down here, for example. And if they're entering here, they would also need to put their stops above this level. So they're getting in with a potential much bigger stop loss. However, they're waiting for that little bit more extra confirmation with their targets down at a certain position. Or if you're another kind of trader, you might just allow price to impulse away and then catch future selling positions. So you know that this is a reversal pattern for future selling positions and selling opportunities. So you might allow the bearish market structure to begin to form and then look for future patterns. For example, you can see this is our first lower high in the market. You might see this as a position to potentially enter the market, or you might allow for another double top over here, as you can see. Some kind of channel here that we've broken out of. You might say that this is a potential position. So the main thing to take away from a rising wedge is that the bullish market structure is losing momentum. Buyers are exiting the market. The bullish impulse is getting smaller, and you're forecasting that sellers are going to step into play and see the market turn from bullish to bearish, and you're going to begin looking for selling positions. So that is how I would attack the rising wedge pattern and how some people may trade off it.